is entirely front-loaded in the setup phase
How does splitting it up make it less stressful, though?
because it prevents cross-contamination of his financial goals. If all $10,000 were sitting in one brokerage account, Ethan would look at it every day and feel the collective volatility.
Oh, right. Seeing the red and green every day.
Exactly. By moving the emergency cash entirely out of sight and automating the ETF purchases, the heavy lifting is done. He doesn't have to wake up and constantly evaluate his risk profile. The structural diversification does the protective work for him. The ongoing execution is deliberately engineered to be boring.
So what does this all mean? We have the portfolio breakdown. We understand the mechanics of the 2050-2010 split. But having the architectural blueprints doesn't build the house.
No, it doesn't.
The narrative tackles the next major hurdle, which is execution paralysis. Ethan knows what to buy, but he's terrified of putting the money into the market today and waking up to a market crash tomorrow.
Execution paralysis is where the majority of theoretical investors fail. They wait for the quote-unquote perfect time to enter the market, effectively keeping their capital on the sidelines while inflation erodes it.
Back to the slow leak.
Right, so Olivia counters this by introducing a systematic deployment method, dollar cost averaging, or DCA.
She tells Ethan that instead of taking the portion of his money meant for equities and throwing it all in on a Tuesday afternoon, he should invest a fixed amount, say $500 every single month, regardless of whether the market is up, down, or sideways. But I'm going to challenge Olivia's logic here. If the fundamental premise of investing in broad market index funds is that the stock market generally goes up over long periods of time, why wouldn't Ethan just dump the whole allocated amount in today?
That's a fair question.
Why drip feed it at $500 a month? If the market is going to be higher in 10 years, keeping cash on the sidelines just seems like you are intentionally sacrificing time in the market.
This raises an important question, and it really highlights the conflict between mathematical optimization and psychological optimization. Mathematically, you are absolutely correct. A lump sum investment beats dollar cost averaging roughly 2/3 of the time in a standard upward trending market. If humans were emotionless algorithms, lump sum is the optimal play.
But we aren't algorithms. When the market drops 5%, we completely freak out.
Exactly the point. Olivia is optimizing for Ethan's psychology. The dual benefits of DCA are profound for a nervous investor.
Right.
First, it directly mitigates sequence of returns risk.
Right.
If Ethan executes a lump sum investment today and the market crashes 20% tomorrow, the psychological devastation might cause him to liquidate his entire portfolio at the absolute bottom. He locks in a permanent loss due to panic.
But with DCA, a market crash completely changes from a catastrophe into a mechanical advantage.
Yes.
If he is strictly deploying $500 a month and the market suddenly drops, his next $500 simply buys more units of the ETF at a discounted price.
It forces him to act contrarian without having to think about it.
Yeah.
And that leads to the second benefit, which is the formation of behavioral habit. By automating that monthly deployment, the decision fatigue is entirely removed. He doesn't have to read the financial news to guess if today is a good day to buy. He simply becomes a relentless, agnostic accumulator of assets.
Taking the emotional friction completely out of the equation. And that exact philosophy, automating good decisions and relying on time rather than timing, brings us to the final and perhaps most powerful concept Olivia drops on Ethan.
The super.
Yeah. She pivots the conversation entirely away from his immediate $10,000 and asks him about his Australian superannuation.
It is a brilliant pivot because she is expanding his time horizon from the next 5 years to the next 40 years.
A huge jump.
She highlights that making voluntary concessional contributions to his super while he is only 24 can create astronomical differences in his ultimate net worth, purely because of the mechanics of compound growth.
Compound growth gets talked about so much, it almost feels like a cliche. Everyone uses the metaphor of the snowball rolling down the hill. You pack a handful of snow, roll it down, and as it gathers speed, the new snow picks up even more snow until it's an avalanche.
Right.
But what the source text implicitly points out, and what savvy investors understand, is that the snowball only becomes an avalanche if two specific conditions are met.
A very long hill and a frictionless surface.
Yes. The long hill is time. Ethan is 24. He has 4 decades before he can even access that superannuation money. The returns he generates in his 20s will generate their own returns in his 30s, which will geometrically multiply in his 40s and 50s.
The math gets crazy.
It really does. But the frictionless surface is just as important, and that is where the tax wrapper of superannuation comes in.
That is the hidden superpower of the Australian super system. It is a highly tax-advantaged environment. For most workers, capital compounding outside of super faces a constant drag from marginal tax rates.
Right, the government always takes a cut.
Exactly. Every dividend, every realized gain gets shaved down by the tax office, which reduces the amount of capital left to compound the following year. By utilizing the superannuation framework, capital compounds at a significantly lower tax rate. The friction is reduced, allowing the mathematical power of compounding to operate at maximum efficiency.
Olivia is trying to fundamentally rewire Ethan's temporal baseline. When he asks her if this slow, automated patience is really better than taking a gamble on the next big crypto coin, she doesn't hesitate. She tells him that true intergenerational wealth isn't about getting lucky on a random Tuesday.
No, it's not.
It is built slowly. It requires discipline. It is, by design, incredibly boring.
And that realization is the climax of the narrative. Ethan experiences a genuine paradigm shift. He actively rejects the mirage of the social media get-rich-quick culture.
He finally unplugs from the Matrix.
Pretty much. He stops looking for an escape hatch and commits to the architecture. He recognizes that informed structural decisions paired with an extended time horizon are the only reliable mechanisms for navigating the degradation of inflation.
He trades the adrenaline of the gamble for the peace of mind of a system. He doesn't have to check his phone every 20 minutes to see if his net worth survived the night.
Right.
But as we wrap up this deep dive into the source material, there is one final caveat Olivia adds that completely recontextualizes the entire conversation. She hands Ethan this meticulously crafted 2050, 2010 blueprint, but then she essentially tells him not to treat it like a religion.
She says, remember, the best investment is one that matches your goals, your risk tolerance, and your timeline.
Which is so important.
It is a vital disclaimer. The structural model she provided is a fantastic educational baseline for a 24-year-old software developer with no dependents and a 40-year runway.
Oh.
But it is not a universal law of physics.
Because personal finance is fundamentally personal. And that is the exact thought we want to leave you with today. Throughout this deep dive, we have analyzed Ethan's timeline, Ethan's risk profile, and Ethan's $10,000. But turn that analytical lens inward. Think about the timeline and the goals you have in your head right now.
Consider the fragility of those assumptions.
Exactly. If your life circumstances completely changed tomorrow, say you suddenly discovered you needed to purchase a home in 24 months, or you were expecting a child, rather than planning for a retirement decades away, how would that drastically shortened horizon flip this entire blueprint upside down?
It changes everything.
That 50% equity exposure suddenly goes from a long-term growth engine to an immediate sequence of returns liability. Are the financial decisions you are making with your capital today actually matched to the specific realities of the person you are right now? Or are you just blindly executing a generic script because it worked for someone else on the internet?
Understanding the mechanics of ETFs, dollar cost averaging, and compound growth just gives you the vocabulary of wealth. Knowing how to dynamically adjust those levers based on the hand you are currently holding is what actually makes you an investor.
Thank you for joining us as we explored these sources today. Keep interrogating your own strategies, keep looking past the noise of the social media mirage, and as always, stay curious.